Welcome to episode 30 of Nova Bourse US. Today, we are focusing on the most critical engine room of the financial world, the Federal Reserve. As we dive into our macroeconomic season, you need to understand that the Fed's next move matters significantly more to your portfolio than any single stock pick you might make. Over the next 22 slides, we will pull back the curtain on how this institution operates and why its decisions dictate the climate in which your investments grow or wither. The Federal Reserve is the most powerful economic actor you have never voted for. It operates independently of any administration, yet its decisions ripple through every asset class you own. When the Fed speaks, the S&P 500, NASDAQ 100, 10-year Treasury yields, mortgage rates, the US dollar, and even gold and Bitcoin respond within seconds. Consider that a single word change in an FOMC statement, like the shift from patient to data-dependent back in 2019, has historically triggered trillion-dollar moves across global markets. For you as an investor, understanding the Fed is not optional macroeconomics. It is a fundamental prerequisite for interpreting why your holdings move on days when no company reported earnings. The COVID-19 pandemic provided the most dramatic demonstration of Fed power in modern history. On March 3, 2020, the Fed held an unscheduled emergency meeting and cut rates by 50 basis points to a range of 1 to 1.25%. 13 days later on a Sunday, it cut another 100 basis points to 0 to 0.25%, the lowest level since the 2008 financial crisis. Markets did not celebrate. The S&P 500 fell 12% the next trading day, triggering a circuit breaker. The lesson here is clear. Rate cuts are not always bullish. Context matters because emergency cuts signal fear, and markets often sell the medicine before they buy the recovery. Congress assigned the Federal Reserve a statutory mandate with three specific goals: maximum employment, stable prices, and moderate long-term interest rates. The first two are commonly known as the dual mandate. Maximum employment does not imply zero unemployment. Rather, it is the highest level of employment the economy can sustain without generating inflation. Stable prices, as defined by the FOMC since 2012, means a 2% annual inflation rate measured by the Personal Consumption Expenditures Price Index. The third pillar, moderate long-term interest rates, is often treated as a consequence of the first two, but it has taken on new importance as the Fed manages its massive balance sheet. The federal funds rate is the interest rate at which depository institutions lend reserve balances to each other overnight, and it serves as the Fed's primary policy tool. The FOMC sets a target range, currently 3.50 to 3.75% as of late 2025, and uses open market operations to keep the effective federal funds rate within that band. This rate influences everything from your credit card APRs to mortgage rates and your savings account yield. When the Fed raises this rate, borrowing becomes more expensive. When it cuts, credit loosens. Keep in mind that this transmission is not instant. Economists estimate a 6 to 18-month lag between a rate change and its full effect. Looking at the last 15 years, we see a timeline of extremes. In December 2008, rates hit the 0 to 0.25% range in response to the Great Recession, staying there for 7 years. December 2015 brought Chair Yellen's first hike. The liftoff markets had awaited. By December 2018, we hit the Powell-era peak, followed by insurance cuts in July 2019. We returned to the pandemic floor in March 2020, then witnessed the fastest hiking cycle in 4 decades, reaching 5.25 to 5.50% by July 2023. Finally, September 2024 saw the first 50 basis point cut, marking a pivot. Every one of these regimes created distinct winners and losers. When the federal funds rate hit its effective lower bound near zero during the 2008 crisis, and again in 2020, the Fed needed a new tool: quantitative easing. This is the large-scale purchase of Treasury securities and mortgage-backed securities on the open market. The Fed pays for these by crediting banks' reserve accounts, effectively creating money. QE1 launched in late 2008, followed by QE2 in 2010, and QE3 from 2012 to 2014. The pandemic program launched in March 2020 added trillions more. The goal is always the same: lower long-term interest rates, support mortgage markets, and stimulate lending when short-term rates cannot be lowered any further. Before 2008, the Fed's balance sheet held roughly $900 billion in assets, or about 6% of U.S. GDP. It was a boring accounting statement. By mid-2022, after 2 decades of QE, it had grown to approximately $8.9 trillion, or nearly 35% of GDP. This represents the largest monetary experiment in history. The composition shifted too. Treasuries grew from about half to over 60% of holdings, while mortgage-backed securities rose from zero to over $2.5 trillion. This matters because the Fed's portfolio decisions directly affect yields and the attractiveness of equities. When the Fed is buying, yields fall and stocks tend to rise. Quantitative tightening is essentially QE in reverse. Instead of buying, the Fed allows maturing securities to roll off its balance sheet without reinvesting the proceeds. QT began in June 2022, with monthly caps of $30 billion for treasuries and $17.5 billion for mortgage-backed securities. After 3 months, those caps doubled. By April 2025, Treasury redemptions slowed to $5 billion per month, and on December 1, 2025, the program officially concluded. The balance sheet shrank from $8.9 trillion to roughly $6.5 trillion. Atlanta Fed economist Ben Way estimated that $2.2 trillion of passive runoff equates to roughly 29 basis points of rate hikes in normal times, or 74 in volatile markets. In a 2025 research note, Fed economists identified a balance sheet trilemma. Central banks can achieve only 2 of 3 goals at once: a small balance sheet, low volatility in short-term rates, and limited market intervention. The Fed chose low-rate volatility and limited intervention, accepting a larger balance sheet. This is why the Fed did not return to its pre-2008 $900 billion footprint. Doing so would have required accepting wild swings in the effective federal funds rate. The Fed now operates in an ample reserves regime, maintaining reserves at roughly 10 to 11% of GDP. Consequently, the balance sheet is now a permanent feature of market dynamics rather than a temporary crisis tool. The Federal Open Market Committee, or FOMC, sets our monetary policy. It has 19 members, the 7 Board of Governors in Washington, including the chair, plus the presidents of the 12 regional Federal Reserve banks. Only 12 vote at any given meeting. All 7 governors plus 5 regional presidents on a rotating basis, except for New York, which always votes. They meet 8 times per year on a fixed schedule, with the policy announcement released at 2 p.m. Eastern on the second day. 4 of these meetings include a press conference and the summary of economic projections, which contains the dot plot. They also enter a blackout period 7 days before each meeting, during which officials stop giving public speeches. The dot plot is the most closely watched page in the quarterly summary of economic projections. Each of the 19 participants places an anonymous dot indicating where they believe the federal funds rate should be at the end of each of the next 3 years and in the longer run. The median dot becomes the market's best guess at the Fed's path. However, the dot plot is not a commitment. Chair Powell has repeatedly emphasized that these are individual forecasts, not a collective plan. Markets often overreact to these projections, and a median move of just 25 basis points in the year-ahead outlook can trigger significant volatility. The plot also includes outlooks for GDP growth, unemployment, and inflation. The June 2025 Summary of Economic Projections showed a Fed navigating persistent inflation. The median rate projection was 3.9% for year-end 2025, 3.6% for 2026, and 3.4% for 2027, with a longer-run estimate near 3%. PCE inflation was projected at 3% for 2025, and unemployment was seen holding at 4.5%. Critically, the range of participant projections widened considerably, signaling deep internal disagreement about how sticky inflation would prove. For you, this wide dispersion in the dot plot typically correlates with higher market volatility in the weeks following the release, as investors try to decipher the lack of consensus. Every FOMC announcement produces one of 3 market reactions: a dovish surprise, where the Fed cuts more than expected or uses soft language, typically causes the S&P 500 to rally, growth stocks to outperform, and yields to fall. A hawkish surprise, where the Fed hikes more than expected or warns about inflation, usually causes a sell-off, with real estate and utilities declining most. Finally, if the decision is fully priced in, the market move is often in the reverse direction as traders take profits. You can use the CME FedWatch tool, which uses federal funds futures pricing to calculate probability distributions to gauge market expectations before each meeting happens. There is a strange empirical pattern known as the pre-FOMC drift. Researchers found that the S&P 500 has earned an average excess return of 49 basis points in the 24 hours before scheduled announcements. Since 1994, roughly 80% of the entire U.S. equity risk premium has been earned in those 24-hour windows, despite them representing only 3% of all trading days. A strategy of buying at 2 p.m. the day before and selling 15 minutes before the announcement would have generated an annualized Sharpe ratio of 1.14. Whether this is due to a resolution of uncertainty or information leaks, the takeaway is that FOMC days are not normal trading days. On September 17, 2019, the plumbing of the financial system broke. The overnight repo market seized, with the secured overnight financing rate spiking above 5%, breaching the FOMC's target range. The trigger was mundane. Quarterly corporate tax payments and a large Treasury settlement drained $120 billion in reserves. However, the amplification was systemic, as reserves had fallen to $1.34 trillion, their lowest since 2012. The Fed responded within hours by injecting $53 billion through an overnight repo operation. This episode taught us that quantitative tightening can create hidden fragility that erupts without warning, even when the economy appears calm. The European Central Bank and the Federal Reserve do not move in lockstep, and their divergence creates tradable opportunities. The ECB began cutting in June 2024, 3 months before the Fed. By June 2025, the ECB had delivered 8 cuts, bringing its deposit rate to 2%, while the Fed remained at 3.5 to 3.75%. This gap matters for 3 reasons. First, a wider rate differential strengthens the US dollar, impacting multinational earnings. Second, global capital flows toward higher yields, supporting Treasury demand. Third, when the ECB cuts faster, it signals weakening European growth, which acts as a headwind for US exporters with heavy exposure to the European market. For 8 years, the Bank of Japan maintained a negative interest rate policy, but that ended on March 19, 2024, with a hike to a range of 0 to 0.1%. They hiked again in July 2024 to 0.25%. The market response was brutal. The Nikkei 225 fell 20% in early August, its worst decline since 1987. This matters globally because Japan is the world's largest creditor nation and a massive holder of foreign assets, particularly U.S. Treasuries. When Japanese monetary policy normalizes, capital that once flowed abroad in search of yield may begin to flow back home, impacting liquidity globally. For 2 decades, the yen carry trade allowed investors to borrow cheaply in Japanese yen and invest in higher-yielding U.S. assets. By mid-2024, this was a multi-trillion-dollar position. When the Bank of Japan hiked rates and the yen surged 11% against the dollar, these trades reversed violently. Investors sold U.S. assets to repay yen loans, putting downward pressure on equities and upward pressure on Treasury yields. Between late July and early August 2024, the 10-year Treasury yield dropped 55 basis points as safe haven buying competed with these position unwinds. By late 2025, with Japanese bond yields at their highest since 1996, institutional investors have a real alternative to U.S. Treasuries. Tracking the Fed does not require a Bloomberg terminal. You have 3 great free resources. First, the CME FedWatch tool, which extracts probability distributions from federal funds futures to predict what the market expects at the next meeting. Second, the FOMC calendar on federalreserve.gov, which lists all 8 meetings and identifies when dot plots and press conferences will occur. Mark these dates as volatility clusters around them. Third, monitor the Secured Overnight Financing Rate, or SOFR, published daily by the New York Fed. When SOFR consistently trades above the interest on reserve balances, it signals tightening liquidity, which is exactly the kind of early warning that preceded the 2019 repo crisis. The Federal Reserve is not merely a reactive institution. It is the architect of market conditions. Its three-pillar mandate creates inherent trade-offs, and its evolving toolkit from federal funds rates to quantitative easing and tightening has permanently changed how the economy functions. The pre-FOMC drift and the asymmetric reactions to surprises show that the Fed shapes the very statistical properties of the market. Furthermore, global actions by the ECB and the Bank of Japan mean that U.S. policy operates in a competitive field where relative rate differentials drive currency flows and cross-border volatility. Fed watching is not macroeconomic trivia. It is a core component of understanding the environment in which every asset in your portfolio operates. Now that you understand who controls the money supply and how they do it, the next episode asks the question the Fed itself is struggling to answer. Why is inflation so hard to kill? We will cover the four types of inflation, dissect the 2021 to 2023 case study in detail, and identify which asset classes historically protect your purchasing power when prices rise and which ones crumble. Episode 31 is titled Inflation and Deflation, the Invisible Enemy of Your Savings. It is a vital lesson for any investor looking to preserve wealth in a volatile world. I will see you there.